Hey everybody, welcome back to our last panel of the day. Probably the one most people have been looking forward to, which is the from past to present, how traditional banks are keeping up.
I guess what I would love to do is just kind of kick it off from, really posing maybe a bit of a challenge, right? Which is that in a sense, it feels like traditional banks are kind of in a very clear regulatory, space. I guess my question is, can they keep up?
If you do not have that security, if you do not have that regulatory certainty, mass adoption will not be following. So I think banks are missing out in the beginning, definitely. But taking into account that we are a regulated entity, that we do not want to take risks towards our clients, towards our customers, we're willing to wait and get first that reassurance about technical and regulatory feasibility before definitely entering. So
I can appreciate that, and that these banking organizations too, they take a lot of due diligence and time to even develop any type of new product and engage in a new market. So, and this will be a multi-year process and vetting process, so they can be assured that there's a quality and level of service that they can provide to their end users, as well as stay in these regulatory guidelines and frameworks that are still being developed.
What DeFi has done in its innovation has shown a new way, through the blockchain technology, a new way to record transactions, sort of a more direct participation by the investors, and certainly quicker, if not real-time settlements. The problem is that there's actually a challenge on both sides. As much as the regulated banks want to sort of enter the space, the DeFi protocols would love to get access to the regulated entities' monies that they control. Because
we're definitely seeing kind of like the reassertion and reemergence of like mass intermediation.
I've often sort of made the case, if you look at centralized or traditional finance, you go through a broker, an intermediary to buy a product that's centrally cleared. Well, if you look at DeFi, you go through MetaMask to talk to a protocol to get settled on Ethereum. The interesting point, though, with the distributed ledger technology, and I think this is the opportunity, is it's actually creating a greenfield opportunity for new competitors.
Most consumers shouldn't have self-custody of anything. That's my assertion.
So self-custody, ideally, yes, you're not dependent on anything or on anybody. But yeah, if it goes about your life savings, then you do want to have that dependence, and then you want to have that trustworthy partner. So
we've looked at this as a explaining this is the future state, in the sense that the nodes may be the institutions may be transaction hosting services, even if they're not your custody. You've got the concept of an asset has to be perfected somewhere, but if it's issued digitally to the network, it's effectively perfected in that network, and therefore can transact. And as a participant, you could be having self-custody, even if you're going through an institution to actually participate in the network.
Because the point is it's less about the traditional banks as institutions per se, and it's more about the scale of liquidity.
DeFi reduces the entry barriers. DeFi reduces the exit barriers, that secondary markets are being created, making those assets more liquid. So from that point of view, yeah, that's intrinsic about DeFi and the promise of DeFi, the democratization of finance, the increase of liquidity.
Well, that's the interesting challenge in terms of getting either real assets or legacy debt and equity or derivative assets into a DeFi protocol, is that a lot of the returns are determined by asset appreciation, which is just because they happen to be new and they go up in price. And that's not necessarily sustainable. So, and there isn't really spread-based lending or active markets that generate real returns. At the moment, it's either a diminishing return or a zero-sum return in some of these markets. So, but the opportunity to get real or structured assets, even digitally issued, that's where I think the real opportunity is going to be in the future. The real thing of the innovation I mentioned at the beginning is the fact that, we've had real-time trading for decades, but settlements are made 1-2 days later, and there's all that friction and acceptance processing. DeFi has shown the way, but the real requirement for an active market is to get to real-time settlement.
And settlement in central bank money, that is the key, So
that
but,
opens up Pandora's box of fractional reserve accounting and identity and everything. Well, we operate with payable receivables as well, so we can actually record the obligation to the ledger, and then that allows counterparties to net and settle over greater amounts of time.
We're talking about introducing delays in settlement.
Delayed settlement, okay, it has its benefits, but what is important, you need to be able to settle whenever you want. You need to be able not to have any hurdles if you want to have instant settlements. That is one of the promises of blockchain and disintermediation, etc. So
in these events that you need a time delayed period, I think somebody will probably invent that wheel in DeFi, and then it'll start being used.
We can kind of find this beautiful, happy medium between what the traditionals have done beautifully well and what the innovators are doing to kind of maybe improve on that.
I would just quickly add, within the regulations, if two counterparties, they can agree any settlement. Market practice may dictate a certain time frame, and obviously people follow it for financing reasons, but actually two counterparties can agree any settlement time frame they want to. So actually the door is open. We've just got to walk through.